next 10 years, something that we've been certainly focusing on these days, because one of the things that we understand is we may not know the 2-year curve. We can have some confidence perhaps in the 5-year curve, but we can be pretty confident on a 10-year curve, although a lot of that confidence seems to be lost these days because we're looking at a lot of carnage. And within carnage, of course, there's opportunity, right? And so the thing that we want to look at first, the carnage, what's going on? Well, we've got this onslaught of bad news, and I don't need to give you the laundry list of what you're hearing every day, but the real key is that we have had an economy that's been buoyed by fiscal stimulus, right? So we've had the Fed stepping in, we've had the US government stepping in, a lot of spending. We've just announced a $31 trillion debt. So the government has been spending a lot of money. The Fed has been providing the kind of stimulus through quantitative easing, especially, and then, of course, keeping interest rates low, so that we've had this entire sort of system that's been spiraling economic values up and up. So then what happens when monetary policy gets constricted, when that fiscal stimulus may be pulled back or somewhat eliminated? Well, now we're seeing kind of the present value really matters, right? So when you're discounting values at a 0 interest rate, well, guess what happens to those values? Well, now you're suddenly discounting them at 6, 8, 10%. Well, now we know what happens to those values. The other thing is that a lot of these values to equities that were dependent on markets that were continuously going to grow and competitive environments that were going to be lax at best. Well, now suddenly, when there's constriction, when there's supply chain disruption, we're seeing that there's valuations dramatically impacted, and in many cases, appropriately so. But when we step back, we realize that economic growth comes from innovation and entrepreneurship. It always has, it always will. One of the things that's happening now is the capital that provides the engine for that growth and that entrepreneurship and then that innovation is greatly constricted now. Because when markets are flying, people are throwing money around. You have something like the Vision Fund, somehow $100 billion in venture capital was going to make sense. Well, if the tide is rising vigorously, yeah, that can make sense. But in normal to constricting economic times, that's not going to make sense, as we've seen, right? And so that also creates opportunity, because now we're seeing that people are sidelined. And we all know when there was a carnage before in the tech world in the year 2000, there were great buying opportunities, right? Amazon was $6 a share, right? There is great opportunity that comes from that. And so we say, markets matter. So valuations matter because valuations indicate exits. Exits indicate values for entrances, right? So venture capital, the engine for entrepreneurship, has been somewhat sidelined. And the smart money is saying, well, there's not enough of a valuation to the exit, so therefore the valuations to current growth rounds are down, if available at all. Valuations to initial rounds are down, if available at all. And so that is putting kind of a slowing governor on the kind of innovation and economic growth that we can see in the future. But it's not gone, right? So what we're seeing, though, is that equities being discounted at higher rates, so equities are down, right? We're seeing fixed income is sort of rising, and we've seen the interest rates associated with high yield debt more than doubling. And so when the yields are going up, prices are coming down. But that also means that cash and fixed income securities now are very valuable for now and in the future. And then we're also seeing alternative assets as private equity, venture capital, these kinds of specialized credit units. Those things can be discounted significantly because they're all depending on an exit that's coming from a market, and the current market conditions are not very favorable. But I'm saying that's short-sighted, right? Because the high cash flow generating companies kind of from now on are very valuable. We know that while inflation may be 6 to 8 to 10% now, depending on your estimate, they are not going to continue. Inflation is not going to continue at that level. So when you have a normalized 10-year perspective, inflation probably does subside. It probably does focus more around 3% annually, which means some of these opportunities today can be quite astounding, right? And we've seen that before with a long-term perspective, that while narrow opportunities have existed before, they've become extraordinary. So the technology was a narrow opportunity for the last 15 years that has returned more than 20% annually. Yet, if you were in kind of consumer staples and other sort of more standard industries, you returned less than 5%. So opportunity is still narrow. And going back to the idea of its innovation, its growth, it's that kind of engine that really drives valuation. That will drive market superior performance as well. And so in the near term, everything's correlated. Markets are down, everything goes down. So whether you're technology, consumer staples, energy, minerals, mining, it doesn't matter. Everything is down because everything becomes correlated. Everyone runs for the door at the same time. But then cooler heads prevail over time, and we see real opportunities, right? And so, as we mentioned before, the punch bowl, right? The infamous Fed punch bowl, or we called it the Greenspan put. Perhaps now we can, call it just the Fed put, because ultimately, if valuations get too low, the Fed will do something, lower interest rates, engage in quantitative easing, do something to drive values, right? Well, when things get a little bit too hectic in the markets, as we've seen Paul Volcker very famously saying, it's my job to take away the punch bowl, right, as the party starts getting going. Well, the Fed didn't take the punch bowl away for the longest time, or they were delayed in taking away the punch bowl. So now we're seeing the punch bowl is kind of taken away. And I know that the Fed has got their eye on, well, have we overcorrected? And, the interest rates are one thing that affects inflation, but when you have supply chain disruptions, when you have limited supply and increasing demand or even stable demand, you're seeing price increases, and interest rates aren't going to do anything to bring that down. So as supply chains become more normalized, as production becomes more normalized, as interest rates have now risen, economic activity is slowing, you are seeing pricing coming down. But at some point, driving the country into a recession is really not a good alternative just because prices are rising, right? So we will see the Fed sort of bring back the punch bowl, as it were. But as we've seen, cash really matters. Cash generated no return if you just held cash. Now it is generating a return. You've got 5-year treasuries over 4%, right? But more importantly, you have cash flow generating companies, whether they're like minerals and mining companies, are generating significant cash flow, and they'll continue that cash flow. And then you've got other securities, even REITs and other cash flow generating securities that are yielding 12 to 15% annually. That cash flow is going to remain, and those opportunities are really there. And so you can look at, we say, the rough waters versus the horizon, right? So the waves may be crashing against the boat, but the smart captain has his eye on the horizon. He sees where things need to go. So if you're being tossed about a little bit today, that's beside the point. The point is that there's a horizon, and there's a horizon for high cash flow generating investments. There's a horizon for innovative companies, technologies, real innovation that can disrupt industries, and large global industries are being disrupted, whether it's finance, communications, life sciences. That horizon is very attractive. In the near term, funding has dried up. It looks like those industries may be going sideways, but that's a very short-term effect. That's a wave on a boat. It's not the horizon, and it's not something to keep your eye on. So the opportunities are still there in those areas. All right, so in summary, we're saying that, yes, there's carnage. There's market carnage. Stocks are down. It's more than a correction. In some cases, 20% or more overall. And some companies are down. We've seen companies down 50, 60% from their highs. Those are the technology companies. Mostly, they've been highly valued. They're impacted now. But markets do matter because markets define even private capital. So venture capital, growth capital, private equity, alternative investments, they're all being impacted. And that ripples back to the engine that really drives growth, and it's innovation and it's private capital that ultimately drives growth. But that growth is driven because there's an exit to a public offering or perhaps an acquisition by a public company. So we get at, okay, when is the best time to invest? Well, when there is blood in the streets, right? And I know that Lord Rothschild said that, and it is always the case that when there's carnage, it's a good starting point, right? Because returns are generated by a starting point, not just an ending point. So we're starting at a lower point. So returns on that very innovation, on those technological breakthroughs, and on these high cash flow generating companies, all those returns will be greatly enhanced because the starting point is so attractive. And that's really the point. So the long lost punch bowl is still going to be there. There is still going to be a put, as it were, that fiscal stimulus, monetary policy will provide. But at the end of the day, the starting point, which is right now, is a great opportunity. And those specific opportunities that I've identified those will be increasingly the best opportunities to pursue. And so, in conclusion, we've identified where there really can be opportunities, where there really can be things to avoid. These companies that were assumed that, well, there'd be no competition, interest rates will always stay low, the present value of those future cash flows will remain high. Well, that's not the case. But now we have starting points that are low, we have growth and innovation that will occur, and real value and future cash flows will be there. And so those investments will generate a high return, and that's where the real opportunities are in this market.